A potential double bottom in stocks. Let's kick off the chart show with the S&P 500. We start out with the breadth indicators, a percentage of S&P 500 stocks above their 50-day moving average, very low, 34.5%. Now remember, when you get a cross of the 50-day moving average to the downside and a confirmation when it tags the underside of the 50-day moving average, that's a bearish picture. And of course, rallies are the opposite, where you want to cross up from the 50-day moving average, confirm and then rally. So when you see this condition where the stocks above their 50-day moving average are really weak, it would suggest that there's a bottom, and we can see that going back to October. And then in December, prices rallied, and now we're into late January, prices rallied, and now look, it's coming back down, suggesting there's potential further weakness as we hit another -2 standard deviation event on this. And you'll notice back in September, when that happened into early October, it was a great buying opportunity. So potential double bottom here coming in the S&P 500, at least from the picture here. Let's go on to the percentage of the S&P 500 stocks above their 200-day moving average, which is at a week 46%. And while we have very little data over the last year, we just have one data point here at the end of January, which was a short-term buy signal. I want you to notice that prices have come down to almost the same level there, but not as many stocks have fallen below their 50-day moving average. So we see more stocks are now above their 50-day moving average. Again, a sign that there is something perhaps structurally weak with this market, that something's missing, perhaps liquidity. If you watched the show on Saturday, look at this from a broader picture. We now move out to the historicals, looking at the percentage of S&P 500 stocks above their 200-day moving average going back to the mid-1980s, and we see what has failed to hold this, which is at a -1 standard deviation event at 46%. When it's failed to hold this, it suggests it's going to come down to perhaps 25, 20, and maybe even worse, so indicating there's a potential much larger move coming here in equities. Perhaps there is a liquidity crisis, could be a massive buying opportunity if it fails to hold here. Let's take a look at the relative strength indicator, the RSI, and what do we see? It went from an oversold condition in late January, rallied up, and remember we talked about this last week, how there's some concern that, hey, if it doesn't get over 50, if it sits down here, that's probably headed lower. Sure enough, relative strength indicators heading down, and again suggesting that the S&P is heading lower. How about the MACD, which is a moving average crossover indicator? Notice the black, or the shorter term moving average, is crossing through the red now. And that, of course, is indicating, again, that there is weakness here, perhaps lower equity prices coming, break through that previous bottom. Of course, the MACD signaling some danger there. How about Momentum Timer Pro? Now, again, this is as of Friday. Report, so which covers up to Thursday. If you want the latest report, click the link up in the corner below or in the description. Right now it's still free, and you'll notice it flashed a sell signal, so it's following kind of closer to what we're seeing with the MACD. Maybe on Friday it had a sell signal. The only way you'll find out, sign up, and of course you'll get your next report on Tuesday due to the market close on Monday, and you can check that out. Let's look at the broader indicators. What do we see on price? 21-day and 50-day moving average headed lower. Only the 100-day, which is going to take longer for it to turn, still showing bullish momentum across all the moving averages, is weakening below all the key moving averages. And now, of course, we're still through the 6-month momentum. And this is going to trigger, as we've talked about before, this is a very academically supported momentum signal length. This 6 months, the longer it sits there, the more algorithms are going to end up selling. Let's head over to the charts and see if perhaps there's any hope in the volume department, and the answer is no. Look at the 6-month volume profile. It jammed up into this twice, double top maybe, and is a very short-term picture. And look, you can see sellers dominating this at 450 on symbol SPY. You see there's not much left holding it down here. If it breaks this, what do we have to do? Let's zoom out to the 1-year chart, and look at that. You see sellers dominating. So remember, we identified up here, these are supply zones between these purple lines. What do we say this was up here? This was a sell zone. We got a false breakout. got rejected, came back down into the buy zone, actually came down 2 buy zones and tagged the one beneath. And now look what's happening. This buy zone right in here is flipping to a sell zone, suggesting the S&P 500 symbol SPY is headed back down, possibly into the 420, 416 range down here to this other supply zone to retest. So dangerous signs there. So is it potential double bottom? Well, we'll need to see a lot more evidence of buyers stepping in here. And let's zoom back in real quick and look at the volume, and notice the volume on these haven't been real strong. So you might want to actually suspect that there's going to be more tests of this low to see if all these buyers here are back in. But otherwise, you can see crossed the 50-day, didn't quite reconfirm it. On the bottom side is crossed the 21-day moving average and tagging it on the bottom side on the way down, suggesting bearish picture for the S&P. Let's go on to the Nasdaq. See if the picture gets any better. See if tech stocks maybe are forming a double bottom. Certainly from a price standpoint, they're looking to attempt to do that. And looking at the percentage of Nasdaq 100 stocks above their 50-day moving average, this would be where you would see a buying opportunity is at 16%. And looking over the last year, look what happened in kind of late September, early October. You had a -2 standard deviation event. We got down to this -16% position, or this my 16% position, and look, the tech stocks rallied. It came back, happened again in January, a little bit of rally, and now we're retesting it. If this doesn't turn into a buying opportunity, well, that means there are major liquidity problems. Let's look at the percentage of the Nasdaq stocks above their 200-day moving average. Again, the Nasdaq 100 at 32%. The last time we got this was down here in January, and that sparked a little bit of rally, but there was no fall through, none whatsoever. And it's coming down, likely to test that again. So if you look and notice, the price now is back where it was before, but there are more stocks above their 200-day moving average, suggesting that those are below are actually falling even more. Let's look at this from a historical standpoint. And when you're sitting here at this 32%, normally you're down here at 25 is a major buying opportunity, suggesting that there's further weakness and breadth here. But looking at 2015, 2016, 2011, lots of opportunities failed to hold here. And now you're going to get a mega opportunity or a big flushing of the markets. You'll notice going back to after the dot-com bubble, 2002, we got down to a -3 standard deviation event, the great financial crisis, 2019, and of course, March of 2020. The question then is, how far can this go? Let's look at the RSI. Same picture as the S&P 500. It was oversold. Remember, we expressed concerns. If it doesn't get over 50, it comes back down. Price is coming down. So we're not back at oversold conditions yet, suggesting tech stocks could head even lower from here. How about the MACD now just crossing over? And of course, that's suggesting further weakness as well when you see that shorter term moving average crossover. How about Momentum Timer Pro? When you see an intermittent buy signal and a string of sell signals, don't put much stake on those buy signals. It's looking for something. This report would be the Thursday data coming out on Friday. Be sure, again, if you want to see where it's at, sign up. And again, it's free right now. So Tuesday, you'll see what the signal was on Friday, which is probably a sell signal, I'd guess. So all three confirming. So if you're looking, how do you use the three together? Well, you're looking for them all to give you positive signals that there's a bottom right now. They're all saying on the S&P and the Nasdaq, no, this is not a bottom yet. How about price? On the moving averages, we look at 21 through 100-day, all headed lower, below all the key moving average. Momentum is bearish. And again, that key 6-month window still showing red as algorithmic programs likely to keep selling, or if they haven't already, to start to sell tech stocks. Let's look at the volume profile. Notice that 6-month, wow, way up there, rejection. And notice we got into supply zone. So let's zoom out to the 1 year, and here that really tells us the picture here is what's going on. Again, up here, sell zone, and this was a buy zone. Buy zone now switches to sell zone. This is what happens. Price comes back up here, and people that previously bought turn into sellers, can't get through, price comes down. So what is it telling you? That here at 341, 340, you're at the top end of this buy zone. This is where buyers need to step in. Failure to do that, and now you're looking at say 322, 320. Let's zoom out over the 2-year window, and you can just see from a technical picture, this is not a good look at all. Notice even where the volume profile is at 2-year mark. So again, we're below the 200-day moving average. You've crossed through all the other moving averages. You're trending the 21-day on the red line lower. Not a good look. If you're looking for a bottom in tech, it doesn't appear that you've got one here. How about small caps? As we know, they tend to lead the large caps. The picture here for the Russell 2000 actually looks better than the other two. We see the percentage of Russell 2000 stocks above their 50-day moving average at about 29% and trending higher. And that's kind of what you want to see, is you want to see it get down to a low level, in this case, a -2 standard deviation. And then you want to see it rise, and you want to see price come with it. And price is, well, rolling over. And that is potential problem here, that while more stocks above their 50-day moving average in the Russell, those that are below it are sinking quick. Let's take a look at the percentage of Russell 2000 stocks above their 200-day moving average, sitting at 32%, hardly unchanged. Remember, we talked about this last week. The breadth here very weak, and price rolling over accordingly. And looking at the historicals, if you want to see what a potential buying opportunity in small caps could look like, is this could get down to the 10% level. If it doesn't move here, then notice there's only one place left to go. That's a financial crisis, another double dip coming out of 2011. You have 2019, March 2020, suggesting that this market could just unload. Let's take a look at the relative strength indicator. Again, couldn't get over 50, suggesting price is headed lower and coming back to a retest in an oversold condition, maybe a double bottom on the Russell. Let's take a look at the MACD. There's your positive indicator that the short-term moving average is still above the longer-term one, but will it roll over and cross lower? Well, if price is in the indicator, it looks like it could come early next week. Let's take a look at Momentum Timer Pro. Much like the RSI, it's got some buy signals. You notice 1, 2, 3, 4, 5 buy signals out of the last 7. So you can see it's kind of fighting that trend. And if this starts to turn lower as well, then you've got 3 confirming signals that not tech stocks, but small caps are headed lower. How about nothing's changed here? We look at the longer term indicators. Price is bearish, momentum is bearish, below all the moving averages, all the momentum signals. That means algorithms are going to be selling this if they haven't already when their trigger point hits, or this date on the calendar. What if they're based on some sort of other cycle? Let's take a look at we need to go look at the chart of that, because there's something interesting I want to show you here on IWM, and we have to zoom out to do this. Notice we have this buy zone up here, or sell zone up here, not buy zone. Here's your buy zone below, and I said for a long time this was a topping pattern. You notice how it comes down and it finds support, and there's not a lot of volume here, just right back to where it was in January of 2021. And what happens here is you get what's called a bear trap, is people start selling this down, buyers come in, flush out some of those sellers. But notice how price has come up, not once, but twice, tag the bottom side of this sell zone. Yeah, it's called a bull trap, or a bear trap, and this is the traps all those people are bearish back in, and then it flushes them all out afterwards. So now you get the bulls that are coming back in here, they're going to get trapped, and prices head lower. It looks like IWM could get down to 170, 160 pretty easily. Let's look at high yield, because junk bonds tell us a lot about the health of the economy. And what do you see? Credit weak. Relative strength indicator is still sitting near oversold conditions. Remember, it can go oversold long periods. You can be overbought, oversold, either way, and that doesn't necessarily mean you have a bottom in high yield. So look at this. Look at the MACD. It's trying to, look like it's trying to come up and form a cross. If it doesn't, well, that is certainly weakness more for the high yield bond market. Let's take a look at the longer term pictures, unchanged and bearish across the board. Let's go over to the charts and see what we see for HYG, if it's going to give the equity market any hope. And the answer is it's not. You can see all these people that were selling, these are a lot of corporations just unloading junk into eager retail buyers who couldn't get enough of this stuff. And looking back over the last 2 years, what do you see? That we're at a point Or if it doesn't hold right here in this 82 level, your next move down is to 81.31. You can go back here and notice where price is at. And then from there, you've got some support at 78. If you can hold that, and after that, it's all bets off. I mean, look backwards here. You can kind of see the point we're at right now. Usually you get bigger moves lower. Let's go out to the 20-year mark. And sure enough, if it's not holding here, you can see 1, 2 points here. Well, that's not a good look for junk bonds. Let's see if we can go out a little bit further, see if we get anything else. Yeah, you notice this point here was a bottom. So yeah, not a good look for junk bonds. It needs to hold up, or signs that we're not in a double bottom, that we're actually going to see lower equity prices. And with that, I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is private educational information only, not intended by investment advice. Do not be construed as recognition or solicitation by a security financial instrument or participate in particular trading strategies. Very well spread by Steve Van Metre. Personal capacity, business express this video that do not affect you, valid, or Steven Van Metre Financial.